short selling, dumb money, retail day traders, and of course, hedge funds. All kinds of terms flying around when stock market news jumps from the business pages onto the front pages, as happened recently after social media fueled investors took some unassuming stocks on a wild ride. Greg Taylor is the Chief Investment Officer of Purpose Investments, and he joins us now from Caledon, Ontario, to help make sense of how it all works. Greg, are you ready to take us through a little course of Investing 101 here?
I'll do my best to try and help out.
Terrific. Could you please explain, here's a new term to many people no doubt, how shorting works?
Yeah, so short selling is a concept where it really, when you get to markets and you feel that the positions in different stocks are overvalued and you don't want to buy them, but you feel you can make money if they actually go lower, what you do is you short sell. And what that means is you're actually selling the security, though you don't own any of it. So what you're actually doing is you're borrowing the shares and you're selling them on the exchange. So someone else is buying it from you, and your position on your balance sheet would be that you're short that company. So at some point you're going to have to buy it back. So you're really making a bet that that share prices of that company is going to go lower.
So just to clarify, you borrow the stock and you pay a fee for the privilege of borrowing it. Is that right?
That's correct. So when anyone goes and buys a stock on the exchange, when you get the share to settle, you'll get, in theory, a stock certificate on the other side to say that you own the shares, and that's yours for as long as you want to keep those shares. Now, if you want to short the stock, you're actually going to be selling it, but you don't have any shares to deliver to the buyer, and the buyer is going to be looking forward to trying to get some shares. But that's going to be a problem. So what you have to do is you have to go to a custodian or a prime broker and borrow that share certificate so that for that transaction to settle, you're going to be able to deliver that share certificate to the counterparty to match, and they can have the share certificate.
And how long do you typically borrow a share for?
Well, it's an infinite contract. So if you're trying to borrow and short a company, you will get a rate, which is going to be an annualized interest rate that you have to pay for the right to borrow the share certificate to settle the share. And there's no term on that. So it could go infinite there as long as you want. Most times short sales are in a few weeks to a month period. So you don't want to do it for too long because it does have a cost, and you don't want to be paying that cost when there's hard enough to make money in the stock market to begin with without having to pay a borrowing fee on top of that.
In which case, how do you make money from shorting?
So when short sales is when you look for an opportunity where you think the price of a stock has gone up more than it should have in either too fast or just gotten too overheated in a crazy move with a stock market bubble. And you're really making a bet that that company is going to go lower in price due to a fundamental reason or a technicality. And you're really hoping that that security is going to go lower. And when it does go lower, you have to close off the trade by buying it back. Once you bought back the same number of shares that you had shorted previously, it'll net out on your account, and hopefully you're buying back at a lower price than you sold it. So it'll still be the same as buy low, sell high. You're just doing the sale first and then buying later to cover.
Can you appreciate how it might sound odd to quote unquote regular people that you would actually make money when a stock does worse?
Yes, but I think what this is all about is just trying to increase both volume in the market and also increase market efficiency. Everyone wants to believe that the stock market and the economies have the invisible hand that'll try and always get to the right price over time due to supply demand. And if people are shorting, that's more of a check in the system that if something's going up too fast, and people will say, well, that price is crazy. And before, if there was no short selling, you could just sit there and look at it and really do nothing, because if you had held it and sold it already, or if you didn't own it at all, there's nothing you could really do other than complain about it. But with short selling, there's a mechanism that you can actually either try and get the price to go lower or be positioned from your portfolio so that you would benefit if it does go lower.
Now, is this something that sort of the typical mom and pop investor can do, or is it really only insiders who know the system that can do this?
Well, you have to have a special account. So you can't just do this in most accounts. You have to get approved by your broker to make sure that you have the sophistication to do this. You also have the ability to line up the borrow that I was talking about before, because technically in most jurisdictions it is illegal to short a company that you don't have a borrow to match off the shares. So this is really something that's normally done through institutions, mainly hedge funds that we can talk about. But so retail investors can do it. You just have to make sure that you've gotten through the correct accounts that are opened up, and your account and broker are allowing you to do this.
Okay, last thing on this, and that is there are a variety of risky investments and instruments that you can partake in on the stock market. If you were going to make a hierarchy of them, where does shorting come on that list?
Well, I would say that from a day-to-day movement on the stock market, I would say shorting is one of the hardest things to do in the day-to-day activity. Generally, when markets do go higher over time, it's easy to say I'm just going to buy a basket of securities or indices, and I'm not going to look at them in 20 years, and I'm going to hope that they're going to be a lot higher. Shorting is much more tricky. You have to figure out where you think there's a mismatch. You have to make sure that you're able to execute on selling it. You're going to be paying a borrowing cost, so it's not something you want to leave on for 20 years and not look at. And it's really quite a difficult thing to do because there's so many things that are going against you that could go wrong. There's a saying, markets can stay irrational longer than you can stay solvent. And that's definitely something that comes up in the shorting argument, because you can say, well, this price of something is crazy, but things do double, things do get taken over, and it's always in the eye of the beholder. And if someone views it's worth a lot more than that, you could be doing all you can, and it's going to go against you, and that can cost you a lot of money. So I would say short selling is one of the things that's up there the most. I think derivatives would probably be the even trickier than short selling, but from an average buy and sell point of view, shorting is more difficult than buying.
Okay, let's go to our next bit of jargon here. Pair trading, what's that?
So pair trading is a concept where you look at two different companies and you think that the relative value of the two has gotten too extreme. A perfect example would be to look at two of the Canadian banks. Most people think that generally the Canadian banks are all pretty much the same. They're all going to act about the same depending on the economy and different market conditions and interest rates exposure. So say you had decided that the valuation of Royal is worth more than the value is looking extreme compared to what TD is trading at. So that would be almost a market neutral pair trade where you would say, I want to short off Royal Bank because I think it's expensive, and I will buy a share of TD or with the proceeds to match off. So you've got the same dollar value exposure. And you're just going to hope that the valuation difference between Royal and TD will contract, and you're going to make money on that game, and you're not taking on any market risk, which could be depending on what the economy does or what interest rates do.
So based on that definition, it sounds like there is a relationship between shorting and pair trading. Have I got that right?
Oh, absolutely. So if you're going to do a pair trade, you need to have a short on the other side. And there's different ranges whether you want to have a perfectly matched pair trade, so you're going to have actually your dollars match off from the beginning, or if you just want to do it where it's one side or the other. Another example of a common pair trade that people put on is when you want to look at resource companies. So say you're looking at the gold companies and you really like this gold company you're looking at, but you're really not sure what the price of gold is going to do. You can buy that gold company and then you can short off the price of gold by shorting an ETF that holds gold. And you're really just exposed to what the management can do to either find new deposits or grow the company, and you can take off a risk. So within different types of pair trading, shorting is a great way to isolate out different risks of your portfolio, so you can really only take advantage of something that's more meaningful to you.
All right, we've done shorting, we've done pair trading. Let's go to our next one, which is hedge funds. Everybody's heard of hedge funds. I'm not sure everybody knows what exactly they are, so tell us.
Well, the definition of hedge funds has changed a lot over the last few years. Hedge funds, as you would have expected from the name, is a fund that's normally hedged. So it's a fund that really and ideally is going to go and make you money regardless of what the market does. So you're not going to be as worried about, okay, if the market's going to go up 20% or down 20%, I want this fund to deliver X percent. And it's usually in the high single digits, low double digits range is what they target. But the definition of hedge funds over time has changed. It's no longer about a market neutral. It's almost started to blur the line to become a more aggressive type fund. Normally to invest in hedge funds, you have to be an accredited investor, and that rule changes depending on what jurisdiction you're in. But usually it requires for high net worth individuals that are willing to take on a little more risk, get into a more sophisticated product. And hedge funds are a good way to look at that. They're going to be trying to do something different that you can't buy in the market normally, and different than normal index fund. It can have varieties of strategies from short selling. It can be looking at more options overlays. It can also be looking at private securities. So you're buying something that's not traditionally on the stock exchange and have access to different vehicles that normally you can't get. So The definition of hedge funds changes over time, but it's really a more sophisticated type of product that normally you can't get access to.
And if it's targeted to high income individuals, what, ballpark it, what are we looking at there?
Well, normally for a accredited investor is someone that has a median income higher than 250,000 a year, or assets under their personal wealth over $1 million. It does change by region. So these are higher net worth individuals that are willing to take on a little more risk and use it for a portion of their investable assets.
Now, you work for a hedge fund that is in the province of Ontario. We hear a lot about hedge funds in the city of New York. What's the biggest difference between the two?
Well, I think the biggest thing is really scale more than anything else. The Canadian hedge fund community is not as nearly as developed as New York. New York would be where the dominant amount of hedge funds are globally. And that's really probably in the magnitude of 90% of all hedge funds in the world would be in New York. So they get really a concentration of people that really spin off from the banks that are dominating on Wall Street. And then they create different niche strategies to try and to get more assets and also to try and generate some alpha versus the stock market. So New York is definitely a more developed market. Toronto's trying to get up there, and I think Toronto over time will start to add more strategies, but the bulk of the assets are always going to be in New York, and it definitely dominates in a global sense.
Is it not the case that many hedge fund people in New York get together from time to time and discuss essentially strategy, how they want to roll out their ideas? That happens, right?
It does, and it's become more of a common practice in the last few years. And they have these called idea dinners, where the different hedge funds will get together and they'll start talking about different ideas. And then they'll always try and see if there's strength in numbers, if they can kind of put on the same strategy at the same time. It's also become quite popular in the last few years. So there's different charity events where the charities will put on different events for investors. Hedge fund managers will get up and start speaking about their best ideas. And people will pay hundreds of dollars for the right to go and listen to these hedge fund investors talk about what their greatest short idea or long idea is, and trying to see if there's any ideas that they can share amongst the group. It becomes a bit of a club where people start to really gang up and try and get onto more different trades. And it really goes back to strength in numbers, because if you've got more people doing the same strategy, you can really start to influence the market more than other times.
Well, this is obviously where I wanted to go next. If Loblaw and Sobeys and Metro all got together and said, we're just going to compare and contrast some ideas we're looking at, they'd be accused of collusion. How is this not collusion?
Well, I don't think it's collusion as much from that type of example, because this is really just people talking about ideas and trying to see if this is an idea that's in all the information's in the public domain. And I feel that this company is more expensive than it should be, and I think the price should go down. If a number of people decide, well, yeah, that makes sense, and more people start shorting it or selling it at the same price, you have more of a chance that the stock is going to actually happen. So it's not really collusion as much, because you're not really doing anything nefarious trying to influence the market. What you're trying to do is just more bounce your ideas off others, get a second opinion, and then hopefully you get strength in numbers if more people agree with you, that the whole process will start to work, and we can get to a price that's probably more fair market.
All right, Greg, next one. We've done shorting, pair trading, hedge funds. Now let's look at the difference between retail and institutional investors. What's the diff?
Well, institutions are really more companies, and these are companies that are set up to invest proceeds for clients. So it can be a mutual fund, it can be an ETF provider, it could be a hedge fund. It could be a pension fund, which is really one of the most common assets. And this is really just people that are professional investors that are set up with different degrees of clients, different degrees of accounts, and in theory it's supposed to be more sophisticated because there's more professional money managers that are looking at these assets and starting to put on risk controls and different compliance and trying to make sure that they're managed more along an institutional sense that's more set up than without rules. Retail investors are really more the do-it-yourselfers that have access to the stock market, have some money of their own from savings, and decide that they would rather do this themselves than hand over their investments to a professional to manage. And there's different degrees of this. Retail investors have become more sophisticated over the last few years, and I think we're starting to see more of an opening with the internet and different tools out there, that the retail investors, which had gotten a bad name before, are actually becoming quite sophisticated and exerting more of an influence on the stock market.
Well, tell me a little bit more about how they've changed the game, because of course, You know, they're all over television now with their ads on how anybody can get in, and for a small or even in some cases, no fee at all, they can be a player in this game. How does that work?
Well, it's really just opening up more tools to the masses. And I think net, this is a good thing. The Wall Street and Bay Street have had a bad rap over the last number of years as being a closed system. And I think having more retailers and retail investors involved and opening up the tools to everyone is going to be better for the overall functioning of the stock market. Now, you will get periods of bubbles and other such where the things get mania, but it really does open it up and become more democratic as people can get access to more tools. Right now, we're seeing the broker and dealers and different platforms offering up different tools such as short selling, more options overlays, and these are sophisticated tools that can be dangerous if people don't use them correctly. But they also are able to bring more institutional style practices of investing to the retail audience. And I think net this is a good thing, but people do need to realize what they're doing and the risks incorporated in that.
And if they don't charge you a fee, how do they make money?
Well, this gets into a more complicated aspect where the dealers every now and then will have set up arrangements where they can sell their deal flow and some of the exchange volume to other exchanges. And this is really where some exchanges are set up that they'll look at what people are doing on the site. They'll try and do some analytics behind that. And then they'll sell the order execution on top of the information to another counterparty who will pay a fee for that and try and collect a bit of a spread from the bid ask in the market. It only really works in high volume exercises, and that's where you can get it's all about scale in this game, as it is in almost every business. So if you've got some scale, you've got some deal flow, and you've got an edge, people will try and sell that and try and exert a little bit of a fraction of some money between the bid ask spread. So investors are getting a bit of a free ride by opening up their information, but they do have to realize that their information is potentially being sold to counterparties, which could try and clip a little bit of a percentage between the bid ask and what transactions are going on at.
Okay, now, Greg, that we have all of this language and the definitions underfoot and we understand the situation a lot better now, in our remaining moments, you're going to tell us what the heck happened with GameStop this past week.
Yeah, so the GameStop phenomenon is going to be quite interesting, and it's definitely going to be leaving a mark and something that the regulators are going to have to look at over time. But really what it was an example that the retail investors started to turn the tables on the hedge funds. And it's going to be fascinating just to see how this plays out. Because really what happened is, and this goes back to the idea dinners or people talking about their shorts from a hedge fund point of view, in the last few years, we've had a number of hedge funds that have really targeted different parts of the market, mainly the retailers. And they're looking at the traditional mall-based retailers and thinking they're structurally broken. These are business models that aren't going to work. So a lot of these hedge funds had shorted these names, GameStop being one of the most apparent ones, thinking that there's a lot of trends going against it. And it's a company that's really in structural decline that's maybe not able to be fixed. And when you get these short positions and different theses, a lot of these hedge funds like to talk their books. So they'll be talking to people in the media, they'll be talking to different counterparties and saying, the best trade out there is to short GameStop. So it became quite well known that a lot of these hedge funds had shorted GameStop. And you can see it in different reports. Different companies publish the companies that are most shorted on different databases. And you can see that GameStop was one of the companies that was the most shorted. What happened to turn the tables on this was a group of investors on different chat rooms, the Reddit boards, decided, well, we can create something called a short squeeze. And that's a different term we haven't discussed on, but a short squeeze is basically when you know that a lot of companies are short, if the stock starts to move higher, kind of going against what you want it to do, it throws off a lot of your risk controls. And the compliance officers at these institutions and hedge funds will start to tap the portfolio managers on their shoulders and say, this is something going against you, be concerned, make sure you're aware of this. And if it gets too out of whack, you're going to have to take that trade off because we don't want to bring down the firm. What happened with GameStop of this is that as people started to realize how short it was and how people started to go the other way to balance off their risk, it started to become a pain trade that as it went higher, it became worse for the hedge funds and better for the retail investors. Where it got more complicated and again, something different than a normal experience is the use of options and derivatives. As these retail investors were buying fairly out of the money calls, which is a very sophisticated strategy to try and move the stock of GameStop higher to these levels And then it basically became the short squeeze that cascaded out of control as the compliance officers were telling all these hedge funds within days, you have to take these trades off, you have to buy it to match off. And to buy it, they had to price the stock up a lot. And that's where we got GameStop moving from $10 to $400 within a matter of days. And it really was more of a technicality run by compliance officers more than anything else.
In which case, when you see the kind of volatility we've seen in this stock over the past couple of weeks, do you think the average person looks at the stock market and says, this is a complete racket? I mean, this is a joke. Look what happened.
It is, and it's probably something, again, that the regulators are going to have to look at, because at the shares of GameStop, there was more than 100% of the stock available outside in a short interest right now. And that's something that really needs to get looked at, because it caused a bit of the short squeeze, and it got more extreme than others with the use of these options. So I think the thing that people are going to have to look at is, should everyone have access to trading options? And also, do we have too much risk in the market if these short squeezes get out of control? At the end of the day, this is something that I don't think is going to happen a lot. This was very like a perfect storm as people were crowded in. I think it's going to be harder to replicate over time. But the regulators are going to have to watch this and make sure that some of these more sophisticated tools, which have now become in the hands of the retailers, retail investors, if they are going to be able to be used for good, or if it's going to start to hurt people over time.
That's Greg Taylor, the Chief Investment Officer of Purpose Investments. And Greg, not only do I have to thank you for coming on to TVO tonight, I got to tell you, that's the best definition of all these complicated phrases and expressions I've ever heard. So thanks for walking us through all that. Appreciate it very much.
Perfect. Thank you. Hope it helped.
The Agenda with Steve Paikin is brought to you by the Chartered Professional Accountants of Ontario. CPA Ontario is a regulator, an educator, a thought leader, and an advocate. We protect the public. We advance our profession. We guide our CPAs. We are CPA Ontario. And by viewers like you. Thank you.